Okay, we got a great show for you tonight. It's December. This is our holiday edition. Welcome to David and Jerry's Real Estate Cafe. This is our first show ever from Wasaga Beach. Well, at least where that I've been in Wasaga Beach. Moved here last week. Good to be here. Laurie here is a real estate agent from Wasaga Beach, right down on the beach, actually. Met her in August when we were looking for homes. Jerry has a place here in Wasaga. I'm not sure what to call it for tax purposes. I don't know what
My office.
his office is strictly his office in Wasaga Beach. And we got an exciting show for you. We got Henry C is here from Ginkgo Mortgage. Welcome, Henry. How you doing tonight?
Very good, very good. Looking forward.
We can't hear you, but
can you hear me now?
Yeah, we can't hear you actually, Henry.
You can hear me at all?
Yeah.
Can you hear me?
And we got Marino Filiplik from
Hi,
True
everyone.
North Financial. He's going to talk about immediate financing arrangements a little bit later on the show. And we're going to talk about mix and mortgage investing with Henry. But first, Jerry, what's new with you, buddy? How you been doing?
Crazy busy.
Jerry, can't hear you either. So we got a problem where we can't hear anyone all of a sudden.
I'm muted. I mean, my mic's working, but
Can't hear you at all, Jerry.
Can you hear me?
Laurie, how about you?
I can hear him
No.
and all of you.
Let's see. Darren can
Maybe
hear
it's
everyone.
you.
Oh, maybe
I think it's the host.
Maybe it's you. Now we can hear you.
Now we can't hear you, David.
Maybe it's the Wasaga Beach internet.
It can sometimes be choppy, but for the most part, it's quite reliable.
Can everybody hear me?
I can hear you, Jerry.
I can hear you. Yes, I can hear
I'm
you.
okay. Yeah.
All right, so I'm going to take over here, I guess. David goes over through some technical issues. I'll give him a minute, and then if not, I'll take over. Okay. All right. Okay. So David's going to figure things out. I'm going to start talking. Welcome, everybody. Yeah, I was going to ask David about his move to Wasaga Beach, but he's already touched on it. And once we get him back on, we'll get a little
How
more
about now?
information.
Can you hear me now?
There you go. Yeah, you're there.
Yeah.
David.
Oh, okay, good. All right. So the move to Wasaga Beach was very smooth. As you know, we moved into a furnished home. It was a demo model. So made our lives easier. It was a pretty smooth move. And I've been here now for just over a week. Weather's been okay. It's pretty cold up here, but it's nice and quiet and having a great time so far.
Nice. That's awesome. Well, we welcome you. Hold on here. Someone's trying to get into our webinar. I'm just going to give them that. Okay. So we certainly welcome you up at the beach. I've been up there for 1998, I think. So I love the area. Try to spend as much time as we can up there. Beautiful area. So it's kind of cool that you move up there. So it gives me more reasons to go up to work. Oops, I mean our office. Sorry, I was going to say cottage, but I meant office.
Yeah.
So yeah. So
well,
anyway.
a lot of people ask me why Wasaga, and there's a couple of reasons for that, Jerry. I've wanted to move to a small town for a long time. And COVID has shown me that I don't have to be in front of my customer's face every day, and I can still do my business. It's mainly electronic. People are getting used to sending documents around. Most of our marketing is also online, as you know. This podcast is a very good example of that. You know, I looked at closely at this whole area, Blue Mountain, Collingwood, Wasaga Beach, and I just found that we could get a lot more home for the money. I wanted a pretty spacious family home, one that my friends and family would feel comfortable coming up to visit. And we, you know, it seemed like we could get quite a lot for our money. And so here we are.
Yeah, well, as I say, I think you'll enjoy it there. I mean, the last year certainly has taught us that yes, we can do business anywhere, and it's just an accepted way of doing business. So
Exactly.
we can be anywhere. So
Right. And tonight we're going to speak with Laurie. She's one of our guests, Laurie Scruggs. We're going to talk with her. She's the principal broker of 2020 Realty Group. As I mentioned earlier, she's right on the beach. So we'll have a chat with her. But Jerry, tell us, first of all, you've got a couple of new things. We're going to do a little tax talk with you.
yeah.
And also you're going to tell us about some financial planning software.
Yeah, so we've had some financial planning software. We have a new version out. I actually created our financial planning software called Financial Vision. It's free for everybody to use, actually, and we just created a new version, and we're ready. It was supposed to be ready today. Now I'm told it's not today. It'll be ready by the weekend. So I invite everybody to go to my website, Canadian Investment Services, download it. It's a free financial planner. We're going to actually have webinars to teach people how to use it. So yeah, we're excited about that. That's been a new development in the last couple of months. So very excited to announce that. I wish I could say download it right now, but I can't. So over the weekend, it'll be ready. So do that. So that's new. Also, David, I want to ask you something that, because I know the Bank of Canada had their big meeting yesterday. So, and I know out of those meetings, come information about interest rates, mortgage rates, and everything else. So why don't you give us an update on what happened out of that meeting, what's going on with our rates right now, and
Okay.
you're the mortgage expert.
Okay, so people, thank you, Jerry. People always want to know what's happening with rates. The Bank of Canada held the overnight rate at 1/4 point. So prime rate is still at 2.45. People want to know, so what do I do? You know, I can save a little bit of money if I go with a variable rate. Should I go with a variable? And my feeling is that even though the variable rates are a tad bit lower, like we have fixed 5-year rate mortgages now at around 1.59%. For an insured purchase, which, you know, rates haven't been that low in a super long time. And although the variable rate is just a little bit lower, maybe 30 basis points lower, I think it's a pretty small premium to pay for having the guarantee to know that your rate is going to be so as long as you plan on staying in the market, you don't plan on getting out, selling your house. I would say it's best to lock in. There was a teeny bit of upward pressure, if you can believe it, a couple weeks ago on fixed rates because with the announcement that Pfizer came out with a vaccine. And that created some confidence in the market, pushing yields up and pushing fixed rates, a little bit of pressure, but it hasn't seemed to have held. The Bank of Canada is saying that they don't see rates going anywhere till at least 2023, but you know, who knows what will be. Nobody expected the real estate market to be as hot as it has been. So who knows how long it'll take the economy to rebound, and great opportunities to buy with low rates. And that's the story on rates. If there's more questions, people can ask me. But Jerry, you normally do a tax talk, so you have some tax pointers before we get into the body of the show, and shortly we'll bring Henry into the conversation.
Yeah, usually I like to talk about something that I might have experienced in the last, since our last session. And I've done a lot at this time of year, and because it's a real estate cafe, I want to certainly keep it with the real estate focus. So what we do at this time of year a lot as we get toward the end of the year, we talk about net rental income, and we deal with the clients that have, a lot of our listeners own rental properties. So at this time of year, we kind of look at the net rent and we try to figure out where we want that net rent taxed. Okay, if you own the property personally, obviously very simple. If you have net rent income, that's just going to land on top of your other income. If it's in a corporation, it's either going to be what we call passive income, which is taxed at 50%, or it's going to be active income at 12.5%. So one strategy we do is I usually try to explain to clients their tax brackets, and personally, it's very simple. You got 4 tax brackets: 20%, 30%, 40%, and 50%. So basically, on average, 0 to 50%, $0 to $50,000 of taxable income is 20%. 50 to 100 is 30, 100 to 150 is 40%, and 150 above is 50%. Now we look at your net rental income, and it's going to go on top of your other income. So if we're into that 40, 50% tax bracket, the last thing we want to do is put net rental income on there. So one strategy we use a lot is if there's a corporation available to us, whatever that net rent is, we'll create a management fee from the corporation to the person to wipe out that income. So we don't want any of that net rent income hitting your personal tax return at 40 to 50%. And we can move that income into a corporation where we're paying 12.5%. So there's a huge savings there. We have to be reasonable, okay, with that allocation. And the minute we say the word reasonable, we're into the gray area of the Income Tax Act, where it becomes interpretive. As I mentioned to all my clients, anybody, the income tax, half of it is written in black and white, and the other half is written in gray. So when we talk about reasonable allocations of management fees for rental income, you know, we're into that gray area of the tax act, but certainly within reason, we can take that net rent income from you personally, move it into a corporation. There's also talk at this time of year whether we depreciate rental buildings. I'm not a fan of depreciating rental buildings. There's other strategies that we can use to reduce the net rent. The reason I don't like depreciating buildings is because assuming buildings go up, you're just going to pay tax when you sell. We call that recapture of depreciation. So if you depreciate your rental property throughout your period of ownership, assuming you sell it for more than you bought it for, you will just pay tax on all that depreciation you claimed. Recapture of depreciation, I'm not a big fan of that. So kind of to summarize that, you know, again, we want to look at the net rent income and we want to figure out where we want to tax it. We will look at your tax brackets. If we're happy with the tax brackets that net rent income will be taxed at, we'll leave it there. If not, we'll try to introduce passive income into a corporation at 12.5%. So that's a little nutshell of what we do at this time of year as far as real estate. So
Okay,
which is probably a good segue, you know, into Henry's talk, unless you got a question, David, on that. Or
yeah, no, I just wanted to say, Jerry, that a lot of people have been watching our podcasts, and I know they've been starting to call you. We're going to put up everybody's full contact information from time to time during the show, and you know, we'd encourage you to get a hold of the people if you have I mean, you can actually, people can ask questions right online. There's one there. Here's one for you. Jerry, Crystal is asking, I was under the impression that you had to have 5 full-time employees to get the 12.5% tax rate on small business corporations.
Great. Thank you for asking that question. So if you have rental properties in a corporation, in order to, if you didn't have 5 employees, so if you're just somebody with a corporation with some rental properties in there, that net rent is going to be taxed at the high tax rate. If you have 5 employees, then yes, you qualify for that low 12.5% tax rate. What I was talking about was if you own the rental property personally, if you have net rent personally, we can charge a management fee from the corporation to you personally. That management fee would be considered active income, taxed at 12.5%. So I hope that answers that question.
Okay, Jerry, are you sitting on a very short chair?
I'm leaning back. You want me to get closer? All right. Here you go, David. Here you go.
Oh, I don't want you to fall asleep on us.
I'm not gonna fall.
Okay, very good.
Anyway, I'm really happy Henry's here today because mortgage investment corps, man, that's I mean, people need to learn more about this stuff, both from a investment point of view and from a real estate financing point of view. So mortgage investment corps have been around forever, and I look forward to Henry's chat and description of them, because they are very valuable tools for people who want to invest money and make a very decent rate of return. And it's also a valuable tool for people who want to buy real estate and use that as a source of funding. So David, why don't you introduce us to him?
Yeah, well, I mean, Jerry, you know, in the investment world and as a mortgage broker, I get a lot of people asking how can they invest in mortgages? They want to, people seem to love investing in mortgages for
People
different
like real estate.
reasons.
I mean, real estate, real estate is a wide umbrella, and mortgages are in the real estate umbrella.
Well, exactly. And with mortgages, it's more of a hands-free, hopefully a hands-free situation, right? You don't have to pay property taxes. You don't have to deal with tenants. Henry, tell us, how did you get into the mortgage investing world? And I mean, what are your clients telling you? Do you find that people just seem to love investing in mortgages?
Actually, everybody is very familiar with mortgages. Like most people have let's say have a house, they have borrowed from the bank before. So they actually, a lot of people know how the mechanic work. You just borrow money from an institution and you have to pay some sort of interest to carry it. And if you don't pay, then your house will be, foreclosed or power of sale. So a lot of people actually familiar with the concept of mortgages. And very rarely they will actually come involved in like private company and do mortgages. And so basically, like this, there's some history to it. Like back in the, I don't know if you remember, on the 70s, 80s, and when the interest rate is super high, like 13, 14%, a lot of people actually can't get to the bank to get the mortgage because it's so expensive. So at that time, the government decided that, like, why don't we kind of generate some other capital from the private citizen, and so that they can participating in lending their own money out to private mortgages. But a lot of people actually don't know how to do like private mortgages. So you pretty much have to go through like yourself, a mortgage broker to find a deal, and then they have to involve, they have to analyze the deal. So the government come out with an idea that why don't we separate a separate entity or a class of entity and say that if you have money and you can put it into a pool fund and let the pool fund actually help you to lend money out. And so that is the background about like a mortgage investment corporation's work. So basically a bunch of investors come together and then put money in, and then so we can carry mortgage. I'll give you an example. So this is a house, like let's say a $1 million house. So first of all, I guess you have to buy the house and for 1 million. And most people actually go to a down payment of 20%. Like this is a typical bank requirement. So for 20% down payment is basically come to 200,000. So that's down payment. Now you go to the bank, you hope that you'll get 80% of the mortgage. As you know that the mortgage right now is pretty much very difficult, and then they will not give you like 80% of your house value. A typical mortgage in a bank will give you, let's say, 75%. So you actually can borrow perhaps up to 750,000, combined with your 200,000 down payment you have. So you basically short a little bit. You short about 50,000, and a lot of times that you cannot close the deal because you short money, and you try to borrow from your relative, and a lot of people say no because it's hard to borrow money from your friends and relative. Now the government see that that's a lot of people cannot borrow like as much as they want, but at the same time, if you can have a vehicle that let private investor to participate in this short, like a smaller amount of mortgage, perhaps let's say 50%, $50,000, and that percentage of 50,000 is actually will help you. Actually, that's a typo. It's not 1.5%. It's actually 25. It's only a 5%. It's not 1.5.
Right. So it's 5% of the purchase price, which is
So
50,000.
Right.
And that's something that the borrower would pay 12% for.
Yeah, because it's a ranking at the second positions. The bank is always the first positions, and the MIC normally a lot of them will lend out as a second mortgage because they're behind the first mortgage, so they will have a higher risk because that will be the first bank will get their money back first. So that is a typical case, and I think that most of the time a lot of people think about mortgages. They think about like subprime mortgage and those are the things. So one of the things that we need to know when you invest into mortgages is what we call the loan to value. right? The LTV. So the LTV basically is saying that if your house is, let's say, 1 million, okay? So basically you will have to borrow mortgages to carry it. So down payment is your equity, okay? So if you see that your equity, let's say is, in this example, can you flip to the number? No, sorry. Oh, Jerry, I mean,
David,
David,
yes.
I'm sorry, I understand what's the problem here, because you have the final slide. Can you make me a like a kind of a temporary host? I can probably do it better that way. Yeah, if you can let me the presenter for maybe one minute or so. Is it doable? Is it doable?
Yeah, can you guys hear me, by the way?
Yeah,
Can
you're
you
good.
hear?
Yes.
Okay. Yeah, it's doable. And I made you co-host.
Do you
So
see?
yeah, hang on. Yeah, you
Yeah.
should be able to share your slides now.
Okay. So basically, just give you this idea. You see my slide now?
Yes.
Yes.
Good, Henry.
Okay. So basically, this is LTV is very important, because a lot of people think about first mortgage and second mortgage. They automatically think second mortgage is always risky or very high risk. It's not always the case, because the risk is a lot of the time is not before, like between one first mortgage or second mortgage. A lot of time it actually depends on the loan to value. I'll give you an example. Let's say that a house is 1 million, and somebody come in and have an equity of 450,000. Okay, so in this case, if you have 450,000, you can borrow 549,000 from the bank, correct? Now, for the 549,000, your loan to the value of the house basically is 54.9%. And if there's a drop in your house value, okay, let's say 10% drop, your equity actually dropped down to 351,000, because the mortgage will not shrink or will not reduce because the house value dropped. So the mortgage always still remain at 549,000. So that will not change. So the key is that to have, when you invest into mortgages, you have to understand how much is the loan to the value of the house. If you have a high loan to value, automatically you have exposed to higher risk. So just because the second mortgage might not always be high risk, let's say that if your loan to value is only 50%, even the second mortgage is only up to 50% of your house value, then I can say it's very, very low risk, because the house price has to drop 50% before your second mortgage become impact or not able to pay you back. So it's very important that in this case, the loan to value actually go up, because the house value used to be 1 million, now drop 10%, become 900,000. So basically now your loan doesn't change, still 549,000, but the loan to value now go up now. So the higher the loan to value, basically is higher the risk. So that is a nutshell when you guys are thinking about, okay, when I have to invest in mortgages, what are the first thing you need to know? I would say that beside whether you are first or second positions, that is very common. You also have to learn about like what is the loan to the value when you invest. Now, if you look back into this, the concept of like a mortgages, right? So the key about like a corp, like mortgage investment corp, the good advantage of it is that you have put everybody money together. So you are investing into a whole bunch of mortgages too. So it's not like you are investing into one house. A lot of people, like let's say that and they want to lend out into mortgages, and they'll go through, let's say David, and say, David, can you find me a borrower who need to have a mortgage to borrow my money? Now, David probably can find you somebody who need money and then lend out your money to them. Now, the only problem about that is that you tie your money into one house. For whatever reason, that house value drop, you are directly exposed to one house, right? So even though the loan to value may be, let's say, lower and you're comfortable to lending to it, still one house is sometimes all concentrate. So in a pool system, like a mortgage investment corporation system, So basically, all the investors sharing all the risk with all the houses. So let's say, for example, our company right now, we have over like 280 different mortgages. And so if, let's say, one mortgage have exposure and you might lose maybe, let's say, 50,000, 100,000 or whatever the number you have, you still can like offset because there's so big a pool. The 100,000 even show up, in the radar because it's relatively small. And the reality is that people get a lot of comfort in investing into a group of funds instead of individual funds. Yeah. So that is the nutshell of a mortgage investment corporation.
What's your track record been like, Henry? How long has the MIC been around?
Now, our make is we started in 2010, 2011. So this is our 9 years of operations. We actually have a track record of paying our investor a minimum of 8% a year. We have been paying the last 9 years minimum 8%. The reason a lot of people say that, wow, why you can pay 8% to the investor? Well, as I mentioned to you, that our fund actually invests into some of the called second mortgages. And as you know, the second mortgages that we see here, which is like a 12% interest, right? Compared to the bank who might charge 2% interest. So because we are lending second mortgages, so basically we can charge, let's say, 12% interest rate. Now, a lot of people will think, well, how can people actually pay a 12% interest? It's like ridiculous. But so you have to bear in mind is that second mortgage by nature is usually a very small amount. So in this case, this example is only 50,000. So if you can borrow 50,000, even though you pay 12%, it's basically 1% a month because it's 12 months a year. So 1% of 50,000 basically is like $500 per month. So some people, they might have short of like 50,000, but they can manage to have $500 per month extra just to carry this second mortgage. Now, by nature, nobody wants to carry a second mortgage for longer than 1 year, or because it's so expensive. So the way that like a lot of people will get out is that after 1 year's time, a lot of them actually pay down the first mortgage. So they get some equity saving in the first mortgage because every month when they pay the first mortgage, they will get some saving in their principal. And plus that they will try to save up additional money in the side. So after 1 year, usually we pay off the second mortgage. So as you can see that our fund actually, the term maximum is only 1 year. And because of 1 year's term, we can predict the house value. Like I know that Laurie probably know that the house market go up, go down, and it's very hard to predict the long term because nobody know like what's the house value in 5 years. But we can very confident is that within this year and next year, within this year, house value might only drop, let's say 5%, maybe, or 10%. Because you cannot, it's not like a stock market, you can drop like 30% in 1 year, right? It's very rare. Even though in Toronto, like when you look back into the 2000 and like the 7 of the tsunami, 2008 tsunami, when the financial crisis, Toronto very flat. The real estate is a little bit drop, but it's not significant at all. We don't even feel the impact. So Toronto market is quite strong in that that type of situation. So to a Toronto market or Ontario market to drop 30% in a year, I would say that that's almost like very, very rare. And so that's why our term is always 1 year's term. And hopefully we can predict the market in 1 year and we can measure our, manage our risk this way. So this is one of the good record that we have in the past 9 years. On average, we have maybe 2-3 so-called bad loans during those years. And most of the time when the bad loans, even though they don't pay, because we can actually sell the house. And if you look back, the market is so cooperative for the last 10 years. So basically when we sell a house, almost 90% will recoup all the money back because the house price has non-stop going up and for the last 10 years, right? So basically when we take over a house to sell, we pretty much every time we sold it, we got all our money back. But of course, there's a certain individual unique cases that we actually lose money, but those are not in Ontario. When we look back on our losses, a lot of them actually is in the Calgary, some of them is in BC, but in Ontario, we're relatively strong. And our portfolio is actually 90% is in Ontario. So give us a good, solid comfort because it's our backyard. We kind of know where each other. Yeah, go ahead.
Henry, within Ontario, do you have some hot spots? I mean, you know, I'm up here in Wasaga now. Jerry and Laurie are in Wasaga. Are you gonna help us out if some of our buyers are short? Is Wasaga in your a list of acceptable lending areas?
Yeah. The answer is yes and no. Yes, we will entertain all the requests, but the no part is that because our fund want to be protect our investor. So there's certain criteria we want to meet. Is that one is that the population for any area that we want to land is minimum is 50,000. So it's because we want to have at least a very liquid market. So 50,000 of population is what we want to look for in an area. The other thing is that we also look for is the background on the borrower. So let's say that let's say your area, Wasaga, might not have 50,000 of population, but we still might entertain if the borrower, the background and the character is good. We'll do that exception and lend it to them. But in general, we want to protect the investor. So we want to invest into houses that are very marketable, so to speak. It's like a lot of people look for it. A lot of people can turn around and buy it. Wasaga is, it may be like the market, the number of transaction maybe like compared to Toronto, definitely will be less, right? So I would say that all depends on the background more than just the location itself.
All right. Well, Henry, you know, I mean, I know as a mortgage broker, I know that you guys are very selective because I've used, you know, I've arranged a couple of loans with Ginkgo in the past.
Okay.
And, you know, sometimes as a mortgage broker, I might say, well, why won't Ginkgo lend? But then again, you know, I think, listen, you know what, if it's my money and my investors' money, you know, of course, listen, I believe in Wasaga, otherwise I wouldn't be living here. But still, by and large, the point is that you have a cautious approach, and as a result, you have a good track record. There are some questions, by the way. So one of them is in a MIC, if you have $1 million invested and a life event required you to cash out, what happens?
Okay, so let's say that you invest $1 million and you suddenly you need money and you need to come out. Now, our fund, every MIC a different. There's no government requirement the operation wise, but our fund is this. In the first year, we don't encourage people to withdraw or call redeem. The reason is that all our mortgages is for 1 year's term. So basically, if your money comes in and we take your money and lend it out to somebody for 1 year's term, I will not see your money coming back after 1 year. So typically, if you need your money, your first year will usually will say that, well, the requirement is that the first year is non-redeemable. Now, many times that people have urgent needs, separations, you know, you need to, or money for health, for whatever reasons, they come to us. We actually will make that exception and say that even though his first year is not allowed to move out, but we still will allow you to get out. Because our fund is relatively, in terms of cash flow wise, very stable. So we can afford to people coming in and going out like quite easy. So the first year technically is no, but if you need an exception, we'll do it. Now, after the first year is open, so everybody who can come out, and let's say that I want money in 12 months time or 13 months time, yeah, we can actually write you the redemption check and let you out. But there's also something called a cost involved into it. If you exit in the second year or redeem in the second year, there is a 2% what we call a redemption charge. It's almost like a mutual fund. Sometimes when you redeem a mutual fund, you have to pay certain charge because it's a longer term. We don't want to encourage mortgage investment almost like a stock, right? We really don't want it to be like very up, coming in and out, in and out. So we try to say that second year you can get out, but there's a 2% redemption charge. But we still, remember, we're still paying you in this environment is 8% a year. So even though you got 8%, give us back 2%, you still have 6% net on the second year. And the third year, if you want to get out, is 1%. And after that, you'll be free to go. There's no other charge to involve. So basically, if you to answer questions, first year is kind of locked in. Second year is free to go, but there's a 2% charge. Third year is 1% charge. After that, you go free, anytime you want. We do have a very, we have a bank, what we call line of credit. So basically, if your investment comes in, we have cash set aside, not set aside, the cash with the line of credit, which can get people like redemptions very easily, I would say, because we have a big lines line up for us to use for that purpose.
Okay, there's more questions. Jerry has one, and then there's more as well. Go ahead.
Question for you, Henry. Thank you for that explanation. Just wondering if you can enlighten our viewers. You're not only doing second mortgages, you're doing firsts also, right? And maybe if you can just kind of describe to us the mechanics of a MIC. Describe to us what the government is telling you, what you can and cannot do.
Sure.
What percentage are in first mortgages, what percentage is in second mortgages, and then if you have a lot of money in first mortgages, does that make it hard to pay out 8 to 9% to investors? And also, if you can touch on how who can invest in these? Do you have to follow Ontario Securities Commission's regulations through like the exempt market? So maybe touch on how your fund is governed, how you operate it, and how you raise money, and who qualifies to invest in the MIC, if you don't mind.
Sure. The government actually has a lot of regulations for us to raise money. First of all, because we are called the issuer, which means that we actually manage the money. They don't allow us to actually go out to just talk to investor and just get the money, because there's, like, as you know, if I'm the issuer and I'm also the seller, I can actually, make up stories and lie to you and say that, wow, our fund is, so good, you missed this opportunity, you're going to miss a big, great opportunity. So the government actually requires us to say that if you are issuer, you need to have a third party to help you to go and to speak to the investor, to get them the interest and to help them to invest into your fund. And those are called the exempt market dealer. And Jerry, I know that you are one of the exempt market dealer. That's a special license.
I was, yeah.
That's great, because this license allows you to understand what is private investment is, and so that you can explain it to your investor. And
so sorry, Henry. So yeah. you're providing an offering memorandum for investors, yeah. Okay.
That's correct. That's correct. So what we do is that we have an offering memorandum, and that one is actually detail about the obligations of who we are and what we can do for you, and our investment philosophy, and how we pay it, and your protection, whatnot. So the whole it's almost like an agreement we do with your money and how we do it, and right. That agreement you can explain to your investor. Now, you mentioned about that the proportion about first and second mortgage. Now, as I mentioned to you that Ginkgo is not only doing second mortgage. Actually, our fund, 70% of our fund money is on first mortgage, and 30% is on second mortgage. So it's a good combination of, first is a little bit more secure, second is a little bit more risky. So combine the two. And as you know, the first mortgage usually is like lower risk, lower return. So we charge a lower interest rate for the borrower. But second mortgage is high interest rate. So combine the two, we can still available can afford like an 8% paid out to our investor. And that is very important because, as I say, a lot of new funds, when they come into the market and they don't have a history, and so they have to go to use the rate to compete. So they will offer the low rates for the borrower so they can get the money out. So our fund is slightly different because we work with practically 2,000 individual mortgage broker. And a lot of them actually have a good history with us, and they like us, like except David, because I didn't.
'Cause he
I
he
didn't give him the
declines my
deal.
deals.
so our philosophy is that we work with a large broad range of mortgage broker, and our hope is that not every one of them will give us all the deals, but if every one of them can give us 1 to 2 deals a year, that will keep my funds going. That's our philosophy. So that's why we work with a lot of people, and hopefully they'll give us 1 or 2 deals. And our fund, unfortunately, like to the mortgage broker, we are not the cheapest. And it is quite a kind of well known that we Ginkgo are not the cheapest fund. But what compensated is that we are known to be the most service oriented. So we can actually close a deal fast if we need to. I can turn around and let's say get your mortgage. If you have people have a last minute deal, I can actually approve it, underwrite it, and actually get the money out within like 2-3 days. So we can.
Go ahead. Sorry.
Yeah. So service, I can charge a little bit high interest so that I can maintain our 8% paid out to our investor. So that is a philosophy that we actually use, and hopefully that will.
So what would, for example, what would a first mortgage rate be? Just ballpark. Are you like you're not offering 3-4% mortgages, are you?
No. No. So our typical first mortgage is 6.99.
Okay.
And the second mortgage somewhere between 8.99 to 11.99.
Okay.
But first mortgage usually is a much larger amount, so we cannot charge as high. So, but by combining the two, and we can create a 8% kind of dividend out.
Yeah.
Okay, I'm going to jump in. There's a few questions, but I want to ask one more, and then we're going to move on. I also want to mention that I am a licensed dealing representative, as Henry was talking about that. And I work through Jerry's company. Well, Jerry's not the dealing rep, it's Huxton Black, but Jerry and I work together a lot. So if you want to know more, we've put up everybody's contact information. You can call Henry if you want, but if you want to talk more specifically about investing, you can also talk directly to Jerry and I, and we can also answer your questions and get you signed up. Henry, is it RSP eligible, Henry?
Yes, it is RSP eligible. So
Okay.
that is a good thing about it.
Okay, so last question I have, and then if we have more time, we'll come back to them. But
Sure.
there was one from Cam. He says, is it almost like bridge financing?
Actually, that's I would say maybe 30% of our deal or borrower have the needs of bridge financing. So not everyone coming to our fund borrow money has a bad credit. A lot of people say that it must be like a poor credit people, or people have a lot of debt. That's not necessarily true. Some of them actually buy a house and they sold their existing house, but has not been closed until maybe, let's say, 60 days later. So they need a bridge. So typically they'll come to us and we can give him a bridge loan. Some of them because of circumstances. I have new immigrant is one of my, I guess, a lot of borrowers actually new immigrant. They actually have a lot of money, and especially like from the Asian market, they come over here. They have a lot of money, but because they have no credit, because the new immigrant is pretty much you have zero credit rating, things like that. So it make them harder to borrow money from the bank or at a lower percentage. So a lot of them actually has money, and we verify their home country bank account, whatever, and we see that they can easily pay us off if they have to. We just have to transfer the money from the home to us. So a portion of them maybe a new immigrant, personal circumstances, loss of like a spouse fighting and need to get out right away. Some of them may be business people just to invest into, let's say, additional office space or whatnot, and they want to use the home to get a mortgage because the bank doesn't like self-employed people. So a lot of our borrower actually has very decent credit. You'll be surprised like to see that, and you'll be so surprised that they cannot go to the bank to get the full amount. But just typical that we can actually have to fit the void about people who are good borrower but not fit the bank criteria.
Henry, what is the minimum investment?
$10,000 is the minimum investment.
Henry,
So,
do you look at like somebody's asking, like, do you look at 9 townhouse projects? Do you look at large projects, or is it
Yes.
just single family?
yeah, we can do that. We consider like a large compound, like a whole project wise, we can do that. As long as there is real estate involved. A lot of people may be mixed up between, you probably heard of it, a lot of people, syndicated mortgages. Syndicated mortgages are slightly different from mortgage investment corporations. Like a single, let's say that a syndicated mortgage usually is a project oriented. So you have a project, let's say Tridel need to build a condo. So they buy a piece of land, but they need money to build it. So they go to the public and say that, hey, how about some of you join together and lend me money and I can build something for you. So it's usually a project oriented. That is a little bit more risky because you're investing into a future, because who knows how long the project will last and how good the project is. But unlike like syndicated mortgage, we must have property already exists. So if we are investing, there has to be a property is already have, let's say 10 houses, it's already built, sitting as inventory, and you need some money to get out and whatever reason. So I need to secure our investment into something of physical. So if you don't pay me, I can take that 10 townhouses and sell it. But
So-
I cannot invest into something that's not yet built yet.
So Henry, when you're investing a mortgage, so it's not the investor's name that ends up on title, it's Ginkgo Mortgage that ends
Correct.
up as the registered mortgage, right?
Correct. That's right. So all the mortgage is public record, as you know. Let's say that if you guys get a chance to go to my website, ginkgomic.com, you will see that our company, one of the high, kind of Google's rating. We have a very high Google rating, and you can see that. You go Google our name and you see it. And a lot of people actually like our website is that we have a lot of disclosure that's far and beyond the basic requirement. So we actually list out all the mortgages that we are now holding in the area, in the specific amount, the rate in our website. So if you go to our website, you click on the mortgage portfolio, you see that where's your money go. So a lot of people say that if I give you the money and you register under Ginkgo Mic's name, how do I know that my money is there? So simple, because we disclose all the mortgages that you can find out, what is Ginkgo's holding. And if you go to a public record, go to search the mortgage title, you will see that Ginkgo's name is attached to that
Right.
house.
So you're registered.
Okay, we
So I
really
got
need to move
really
on though.
important question. I got one really important, the most important question. Henry, how do you come up with the name Ginkgo?
Okay, very quickly. Ginkgo is actually, I don't know if you know, it's a plant. And it's the most durable endurance plant, or the most hard living plant. And if you know that the history of the atomic bomb in Japan, and after the bomb, the first living things coming out from the ground is a ginkgo plant. So
Interesting.
it's a symbolic of that we will not die. We're going to endure for a hard time. We're going to keep surviving, even though this market might crash. We're still there for you.
Okay, much success. Again, people, you can contact myself, Jerry, or Henry if you want to know more about Ginkgo. If you have time, Henry, stick around if you can. If you got to go, we understand, because we may circle back with you if we have more time. Because there were some other questions. Check out the chat bar, because you'll see there were other questions. Let's move on now. Let's talk to Laurie Scruggs. Laurie, welcome. We appreciate you joining us. I met Laurie in the summer. I spent a couple weeks in Wasaga. She showed us around. She showed us some amazing properties. Her area of expertise, I would say, is probably the the beach and the beach area itself. I believe, but Laurie, tell us a bit about yourself. You have a fairly new brokerage. You're the broker of record for 2020 Realty Group, and I know it was great dealing with you because you really followed up very nicely and you provide us with a lot of valuable information. So tell us a bit more about yourself and what you do, please.
Okay, thank you. Thank you for inviting me here this evening. And it was a pleasure meeting you at the open house. I mean, my time in Wasaga Beach started back in 1997. I was on vacation with my sister, and my husband bought a new car. And what does man want to do when they get a new car? Is they want to ride up 400 to Wasaga Beach, and you want to drive on Beach Drive. So we did that and ended up walking into an open house. Oddly enough, often as an agent, you do an open house to please your seller, to show that you're working hard to sell it. But often you don't sell a property from someone who walks in off the street. But my husband bought it, picked me up at the airport with a Polaroid, said, "We have a cottage." And it was a glorified shed, and it was lovely. It's the funnest 4 years that we've ever had. And that got me there. And then once we were there, we realized how much we enjoyed it. It became a mecca for friends and family. And oddly enough, I normally take the way towards the main end back down to the GTA because I was born in Toronto. But we went another way, and that's when we saw the beachfront, and that was available for sale. And we purchased it because I liked the gates. It reminded me of the beach properties in Italy where they were all gated and you'd have private beach properties or apartments with steps to the beach. That got me there, and I've really been enjoying beach living. As you can tell, I have a passion. I lived, when I met you, I had just come on to the project. You were the first contact that Joe Trissini of JDF Realty gave me. That's who I joined. I asked them if I could join them. I said, "You need someone up here." And they agreed to allow me onto the project. We've sold them all now. But what a great day it was to meet you there. And I'm really happy for you that you bought your property there. I'm just going to, now that you're officially a Wasaga Beach resident, it's Wasaga Beach, not Wasaga Beach. Everyone from Toronto calls it Wasaga Beach.
And
Okay.
Laurie, is that because
Wasaga.
it's not a Wasaga? Is that why it's Wasaga and not Wasaga?
Yeah, it's the Wasaga River, and it's Wasaga Beach. And it doesn't sound right, but that is the way you're supposed to pronounce it. And interestingly enough, if you look at a map of the area, you've got, for instance, where I met you there in that area there, Beach 3 area, that's essentially a peninsula, because on one side you've got Georgian Bay, and then on the other side you've got the Wasaga River. So the way the real estate has gone in Wasaga Beach, you could have properties that are along the beachfront that are let's go back 15 years ago, that were worth $550,000. And you could have another property across the street on Shore Lane that wasn't beachfront, and that would go for half of that, maybe even less than half of that. So the beachfront properties in Wasaga Beach always seem like they're too expensive to buy, and they always go up. When I purchased mine, it cost me more than my GTA home. But it was, and it has gone up considerably. Like this year, our market, our stats, we've gone up 30% from last year at this time.
Yeah,
in
I've
Wasaga
noticed
Beach.
the last year. I mean, I've sorry to jump in, but I've been up there since '97 or something as a cottage, and we've seen the boom in Collingwood, and way back, we didn't really see the boom in Wasaga, but my God, in the last year or two, we've really seen the boom there. I mean, prices have gone up quite a lot up there.
Wasaga Beach is it's a gem. It's a hidden gem. There's so
Right.
much going on in Collingwood, and that's why I feel like Collingwood is beautiful. I visit there often. I just don't think there's as much room to grow. So I think you made a wise investment, David, and you, Jerry, purchasing all those years ago, because there is still a lot of room to grow. They haven't gotten their act together in the main end. So the main end would be over the bridge that they're now redoing, where Park 1 and 2 are. That's your main end. And they had that fire and the bankruptcy and all of that. But now we're in a good position for growth because the town purchased all the beachfront property there from the company that went into receivership.
Right.
So now we're looking for partners to partner up and develop that. So any areas where you can walk to the main end, enjoy those amenities, those are going to grow considerably. Any beachfront properties is always a safe spot. You know, the riverfront properties along the Wasaga River, those used to go pretty cheap. Now those have come up. This year we've had sales for over $1 million. There's never been a property on the Wasaga River that has sold for over $1 million, and yet we have 3 listings and we have some sales over there.
So
So
Laurie,
yeah.
why do you think that just happened in the last year as opposed to the last 15 years? Because Collingwood really over the last 15 years has gone up, and really Wasaga really, hit a home run in the last 12, 18 months. Like why do you think it just happened now?
Well, I think part of it is what's going on with, you've got COVID, people have to stay home, and so they'd rather be up there. Also, with mortgage rates now at 1.6, 1.7, I know a client got something for 1.7. Money is very, very cheap. People are seeing now the potential. Collingwood is a lot more expensive. Another thing with Collingwood as well is that a lot of these beautiful, beautiful communities appear to be a bit cookie cutter, and you're always tied to maintenance fees. So when you consider how much you're spending in maintenance fees, if you were to consider that as part of your mortgage payment, you can purchase more property, and then it gives you more control on what you're doing. But I think a big reason why people gravitate to Collingwood is because there's a lot more amenities there. And people would ask me, oh, I've been up here 20 plus years, and they would ask me, what do you do there? I walk on the beach. I watch the sunset. I sit inside and put wood in my wood burning stove on a very, very cold day. I'll walk on the frozen bay. There's a lot to do, and you can meet. You go out, you meet people, you enjoy swimming. One of the things my family likes to do is, we haven't taken our boat out much, but there's nothing like jumping off your boat in the middle of Georgian Bay in a hot summer day. It's a lifestyle. And we started enjoying this at times when my kids were small. My husband was working from home back in the day as a programmer. So we didn't need to be in the GTA, and we would spend a lot of time here. And we thought, imagine that. Imagine being able to go to work and come home and still be able to go out for a sunset cruise on your boat. Or imagine being able to go night skiing after you put in a day's work, or taking the kids snow tubing. Being up around here allows you to really maximize your lifestyle, I think. That's a big part of the recent attraction, and people are only discovering. We have the world's longest freshwater beach, 14 kilometers of pristine sand here. And we have a history as well. For instance, in 1934, the first transatlantic flight from Canada over the Atlantic launched from our beach, because there weren't a lot of runways in 1934, and they thought, well, how can we get this plane on a runway? You couldn't use the military ones. So the town came in, the kids and farmers and people, they cleared the beach of twigs and rocks and got it all ready to go, and they flew across. And they were supposed to go to Baghdad, but they ended up in Middlesex, England, but they still managed to cross. And I don't think a lot of people know that. We also had a battle in the War of 1812 here. So there's a lot of history. So all of that's going to come together.
So-
And when it
Right.
does come together,
Laurie, I got another question. Like,
Yeah.
I spent a lot of time up there, and I've always like you're right. It is beautiful. I mean, the walk's a lot, 14 kilometers, the world's largest freshwater beach. So I've always kind of thought that. Tell me if I'm wrong. I really thought from an economic point of view, I almost thought Wasaga really has never really optimized what they have. I mean, you're an hour and a bit from Toronto. I mean, it's beautiful. And I've just never seen them really develop, and they've tried. And I know I think before 2008, they had a pretty nice development casino hotel down in the main beach. And then 2008 kind of destroyed that. And since then, it's just really nothing as much has happened. And God, I've just started recently following the politics in Wasaga. Oh my God, what a gong show going on up there. I mean,
Yeah.
can you enlighten me? Like, am I right? Am I wrong? I mean,
no, you're absolutely right. So our previous mayor, Brian Smith, he ran as a Wasaga Beach boy who's done well for himself and wanted to see Wasaga Beach come back to its former glory. So what he did was he ran an aggressive campaign. He won, and he had big plans, and he was going to get us our double pad arena, library, convention center, auditorium, and he wanted to bring everything out onto the beachfront. And he had managed to broker a deal with Fram,
yeah.
who built the shipyards in Collingwood.
Okay.
And then the election happened. And the next day, everyone was pretty shocked. And I just don't think that even though there was a lot of support for the project, they didn't show up and vote. But now there is a lot going on now. You've got residents that are very vocal and very active in the community. You've got former Toronto councillor coming in and basically looking and telling people what's going on and advising people on, how we could make things better. So I really see, we'll have to wait for the next election, 2022.
That's Giorgio Manalini, right?
Yeah, Giorgio Mamaliti.
Does he live is he a resident up there?
Yes, he's been living up here for about seven years.
Okay,
And
he can make things happen.
he can, especially when you consider some of the portfolios that he had in Toronto. For instance, affordable housing. He actually wrote, basically the plan for affordable housing. And we really need that here because part of the eyesore that is Wasaga Beach is that some of these property owners, they have cottage courts and they haven't upgraded them, and they are sheds, maybe worse than my first cottage, and they rent them year round, and things just aren't cared for. But the thing is in the past 7 years, all of my clients have all been sophisticated, savvy Toronto people. The demographic is changing here. People now are realizing that this is pretty cheap for what you get.
Yeah.
And I think that's where you see the price increase happening. I also interestingly noticed that I was looking for some leasing space. There's not much out there to lease. We used to have a lot of empty commercial space. That was the joke. Why are they building all this commercial space? It's hard to find commercial space. And even for an investment, if you're looking, for instance, I had a client, they were looking to buy a condo from a big development in Toronto. Then they changed their mind. They actually got out of the deal, that 10-day cooling off period. He ended up buying a house in Collingwood. He rented the basement and he rented the upstairs. And he said, you know what? I have a freehold. I spent less money and I'm making more in rent. Because believe it or not, the rents are not that much lower than Toronto. But to buy in, it's a lot lower. So it makes a good investment.
Laurie, somebody's asking you if you know where Thunder Beach is.
Thunder Beach, that is up. It's near the top tip. It's up past La Fontaine,
Oh, up
and
there,
it
okay.
would be, that would be in Tiny Township,
Okay, way up
and
there.
it would be northwest of Penetang, not too far from Owenda National Park.
Gotcha.
or
Another
Provincial.
question for you, Laurie. So like, I know this downtown has been, kicked around forever, and I probably wouldn't get a whole lot of support. So even suggesting that there's some component of residential in that area, but would that not attract more development, more developers, if they did actually add some residential, some high rises? Because I've seen that. I'm now kind of following the Facebook banter with all the politics that's going on there, and I mean, it's unbelievable what's going on there. I mean, $60 million to put 2 ice pads in a library and no government grants, all on the back of the taxpayer. My God. I don't know
Yeah,
what to say about that. That's
we're hoping that that doesn't happen, because nobody wants to foot that bill. It's time to re-envision. 2020 is a new time, and it's everything is being done differently, and they need to consider that and do it differently as well. I think there should be high rises, in my opinion. I think a rooftop patio.
yeah,
I think a convention center. I think that
yes.
it would be perfect to have a floor to ceiling ballroom where you could have weddings at sunset. People will come. People will come.
I just think you'd attract more development dollars, because really just anybody that's going to spend what it takes to redo that whole downtown is going to look for some taxpayer support, because it's hard, because with Sega, you've really got 4 or 5 months to make your money. Now you're into the winter, and so it's very hard from an economical point of view to make the math work for a developer to come in there and spend what they have to spend to redevelop that whole downtown just from a commercial aspect. But now if you allow that developer to build some high rises and sell the condos, now you got a fighting chance for somebody to spend their own money down there, as opposed to it being on the the back of the taxpayer.
Well, that's pretty much what a lot of people are talking about. There's a lot of models to follow. The Village at Blue did that. They sold off
Yeah.
The condos, and
Yeah.
then you enter into the rental pool, you put yours, and they rent it out for you, and you'd get a percentage of that, and they take a percentage and they maintain it for you as well. That model could work very well.
I agree. And I think they should all, just my opinion. I mean, it's one thing to have it the way it was, where you're really attracting all the young kids, but why not build it so, there's an attraction to adults? They're the ones that spend money. I mean, not the young kids. So if you make it more adult focused as much as, crazy young kids focus, I mean, I think I don't know. I look forward to seeing where it goes. I hope there's a whole rethink of what goes on down there, because something has to happen. I mean, the way I kind of looked at it, it's become so bad that they can't leave it. Something has to happen pretty big. Hopefully the government, the layers of government need to align. I mean, the feds need to be aligned with the province, and then you'll see some money go that way, and hopefully they'll do some development, because you're right, it's a gem. It's an hour and a bit from Toronto, and they really, other than young kids going up there every weekend, I just find they really haven't optimized that from a commercial point of view.
They haven't, and we don't have the right accommodation. People want spas, and people want hotels where you can book several rooms, and you do want the convention center. You want concert halls. The glory days of Wasaga Beach are gone. We've lost our identity. We have to reinvent ourselves. It isn't palatable to come and see drunken kids out and about.
Right.
But at the same time, we want to welcome them, because why did my husband get on the 400 that day to where we bought our first place? Because he went when he was young. He said, "You want to feel young? You go to Wasaga Beach. You go for a drive.
Yep.
There's always amazing cars. You want to see some of the best motorcycles around? Come up and see and these people are not biker gangs. These are doctors and lawyers who buy beautiful motorcycles, and what else you want to do but cruise down by the beach. You see some amazing classic cars. We used
Yep,
to have
yep, yep.
Corvettes every year.
Yeah,
A lot of people,
The Corvette weekend. I mean,
yeah.
that was awesome. I mean,
And well, this past year was difficult. What a year 2020 has been with COVID and the high water levels. And a lot of people are concerned of the high water levels. And I got to tell you that on my property, I had about 40 feet of sand from my break wall. And then from my property line, there was about 200 feet of sand. This past year, the water came up on my property line. It was basically the shoreline was on my property line. So that's how much the water has come up. But when I came up here in 1997, my neighbor across the street said, don't worry, the water's high, but it's going to go down. It's a 35-year cycle. And if you talk to Charlie or Eddie or Bob Sweeney at Sturgeon Point Marina, they'll tell you all about it because they know the river, they know the beach. They've been running the marina for 50 years. They know, and it's a normal thing. That said, you do have to be careful when you're purchasing a property. Always good to check and see where it stands with the Nottawa Valley Conservation Authority, because you want to make sure that if you're buying something to be able to build in the future, you're not in a floodplain. And those are issues usually when you're purchasing riverfront properties.
Okay, so that was very informative, and I encourage people to give Laurie a call. And Jerry and I are going to be looking for places where we can set up like a real estate cafe and do events like we used to, where people actually were able to see each other in person. Before too long, hopefully the vaccine will be around by next spring, next summer, and God willing, life will get back to normal. So again, people, we have your contact information. Terry Wallman, a friend of ours, noted that he had some properties in his possession that he in the tiny township area that he was looking to sell. So Laurie, I'll send you an email introduction with Terry later tonight or tomorrow morning. Let's move on. We've got Marino Filippic from True North Financial, and we want to talk to Marino about immediate financing arrangements and insurance. Marino, what is that? Oh, I like urgency. Tell me, what is the immediate financing arrangement all about?
Well, immediate financing arrangement is a concept that is really worth talking about to people who want to build wealth and want to be able to leverage an asset in doing so. And in this case, everybody has heard about life insurance, and in particularly a participating whole life insurance policy. Now, everybody thinks about life insurance is only for an estate situation after you pass away, but that's the primary focus for it. But it's also designed for the living. And in speaking about that, is a life insurance policy is classified as an asset. And seeing Henry's designations behind them, I think he's very familiar with that concept. And he can chime in whenever he wants to on the concept or not. But basically, it's taking an insurance policy and using that as an asset, and then going to a bank and using that asset to collateralize a loan. And the nice thing about it is that the banks will loan up to 100% of what the cash value is in the participating whole life policy, which will allow you to reinvest that money that you've borrowed back into your real estate portfolio, your business. And the key to it is that it has to be reinvested into an asset class that's going to generate a profit, and that is under the CRA guidelines. So the nice thing about this is if you have, in Jerry's case, as he was talking about being an incorporated company, the monies that you borrow and the interest that is being paid is income tax deductible. Not 100% of it, but a good portion of it. So what it does is it allows you to do two things. It continues to allow you to build wealth on one side, in this case, a real estate portfolio business that you have. And then the other side is building wealth inside the life insurance policy, because that policy continues to generate every year dividends. Now, the average, depending on the insurance carrier, is between 5 to 6.5%. They've been generating about over the last 100 years plus years. There's always been a dividend issued to the investor of an insurance policy who buys one for himself or for his corporation. So that's it in a nutshell. Because of time, I'm just looking at time. And if there's any other questions that people want to ask, I might have to leave it there. But Jerry, if you have any questions, or David, maybe I can expand on that. But that's the nutshell, the framework.
Yeah, so maybe just for our viewers, touch on how we build up cash surrender values in a participating whole life
Okay.
policy.
It's a great question, Jerry.
And that being the asset that we can
Right.
leverage.
So the usually what happens is we do a full analysis of the individual who wants to have a look at and see if it's possible. And we usually like to start off with the insurance companies like to start off with 100,000 as an annual premium. Now, I don't know who would be willing to put up $100,000 every year going forward for the existence of the policy. But the benefit to that is it continues to build cash value. And when you do it immediately in the first year of $100,000, you can take that and actually go to the bank. We would work with you in dealing with the bank to get you the collateralized line of loan to be able to reinvest it back in your business. Now, the thing in this particular case is you have to have the cash flow to be able to do this year after year after year. Now, the nice thing is that usually after 5 years, you have so much cash value that's been generated in your life insurance policy that what happens is, with regards to the loan portion from the bank, is the banks have identified that now you reached an equilibrium where the paid up additions now exceed the annual premium, where now it's self-sustaining. So now you have a self-sustaining life insurance policy that's generating a lot of dividends every year, whereby every year those dividends now are generating more than $100,000 into the cash value of the life insurance policy. So in the short term, basically over a period of 4 to 5 years, depending on the insurance company and the lender, they may only require an additional collateralization for the 100,000 for 4 or 5 years. And the best way to demonstrate that is to show it on paper, just to show you the numbers and how it works. And once you see how the numbers work, then it starts to make perfect sense. And the reason behind that is that it's just straight math is what it is. And in addition to that is you're able to capitalize on interest deductibility, and that's huge for an investor who is investing in real estate or has their own business and wants to redeploy money and reinvest it into their business. If you also have a business and you have a holding company, with the tax legislation that has occurred since 2018 for the small business deduction, you can use the holding company to hold this life insurance product in your holding company, where now you can borrow against that and redeploy it into the operating company of your business, or if you want to invest it into a MIC, as an example, with Henry's company, you can. And because the main thrust of it is it has to generate a profit to be able to be worthy of the CRA requirements.
So Marino, is it any bank will lend against the cash surrender value, or are there specific banks that work with the insurer to?
It's a great question, Jerry. There are banks that do work with the insurer. It boils down to the individual and where they are financially in terms of their credit is an area that is looked at. Their cash flow, what do they have in terms of overall assets, and as well as the size of the annual premium of the insurance policy. And the reason why I say 100,000, it just becomes that much more easier. That's not to say that you can also apply for one where a premium is 30,000 or 50,000. It just becomes a little more expensive to manage from an administrative perspective. And also it could, from an interest rate perspective, when you're applying for the bank loan, because you have to do them both at the same time, because all the information is being done at the same time as far as qualifying for the insurance policy as well as for the bank loan. So in one essence, it's like applying for a mortgage, and then you also have to go see Henry to top up if you're a little short. Kind of the same principle. Okay.
Okay, got it.
Okay, I want to suggest that we take a look. Thank you very much, Marino. That was a very good presentation. I learned something new every time, and I know you're a wealth of knowledge. So we put up everybody's contact information. Encourage some of our viewers to reach out to the individual presenters. I want to take a look at some of the Q&A that we have, and then because we're just kind of going to be wrapping up before too long. There was a comment, actually, what's happening to all our questions? Jerry, there was a comment early on, it's 7:45 p.m. I think we were talking about taxes. Is there any difference for residential versus commercial property? Could you know what the context, do you recall?
Sorry, is that me or Henry?
Yeah,
Sorry.
no, I think this is for you, 7:45. I believe it was for you.
Sorry, well, okay, what was
Is
the
there any
question?
difference for residential versus commercial property? You were talking about rents and expenses.
No, I mean, if if you own a rental property, a residential rental property, all the concepts, the tax concepts about claiming depreciation, what we do with the net income of the rent is similar if you owned a commercial property. So yeah, there's no difference between a commercial or a residential rental as far as the tax concepts and implications that we have to deal with.
Okay, he wrote something else there. Do you see his comment, Rocco? Within an incorporated company.
Okay, hold on.
There were a bunch of questions for Henry too. I want to know what happened to them all, but
Or maybe I typed the answer
oh,
already.
did you type answers? Okay.
Yes, sorry.
Once you
very
put in
good.
answers, it kind of goes away. So
Do you want to, was there anything there that maybe you want to highlight to us? Because here I see answered.
here we go. Okay, yeah, if you click on the answered ones.
Here, how many homes have you had under power of sale? Average 2 to 4 properties per year in our history that went into power of sale. Since the real estate was very hot for the past 10 years, most borrowers choose to sell their properties on their own. Right, of course.
So yeah, so I think they were asking Henry, have you had the power of sale properties?
Right.
Yeah. Like a lot of people think that every time we go to power of sale, we lose money. Actually, the opposite. Because when we go to the power of sale, we charge so much fee and penalty and expenses, right? And so basically we eat up a lot of the equity. So we actually come out a lot of times ahead of the game.
Yeah, actually, I do a lot of private mortgage lending with my client base, and I've had to twice power sale a property, And what we do is we put clauses into the mortgage that protects the investor. For example, if your arrears in your property taxes, another fee kicks in. If your arrears in this and this, if you don't pay within the 1-year maturity. So in both those cases, the client just came out so far ahead. Both those cases ended up with the client. The average rate of return for the length of the time they lent their money was well over 25% once we added the fees. So, I mean, don't be afraid of the power of sale. I think Henry hit the nail on the head. It's loan to value. I mean, if you're funding second mortgages and the loan to value is still very acceptable, you know, even if something goes wrong, the value is there. If you've got it clauses, the proper clauses in a mortgage, your lenders are making even more money. So yeah, so it's you know, that's why I say I'm glad we had you on, Henry, because private mortgage lending to me is such a you know, is such a worthy investment option. People really need to explore.
It's also a hidden secret too. A lot of people don't
And then when you
understand
get
it.
like a MIC, like people really, that's why, Henry, thank you for sharing what you did, because a lot of people don't understand MICs, and it's really just private mortgage lending, but you're doing it as a group and you're having professional management administer those mortgages. So it is a hidden secret. I mean, as you said, Henry, you've been paying 8%, I think,
Yeah.
right, to investors. I mean, you know,
like the compounding things, like if you have 8%, like typically the rule of 72 will say every 9 years you double your money.
Yeah.
So I personally see my money double, because when I started the fund in 2010, I put money in like just like my investor. So I can actually the nine years I see my money from, you know, double it now. So if I hold this double amount for another 9 years, it'll be like 4 times now, right?
Let's go around the circle, and if we would, everyone just give us their final thoughts. This is the our last show for the year. Henry, you want to give us your final thoughts and wish us a happy holiday. We'll go around the we'll go around the table.
Yeah, thank you for inviting me, Dave and Jerry, and it was a great pleasure meeting you guys online, and hope you guys make, I guess, better use of your money for the coming year, because the bank interest rate are so low, and we have something that actually can help you in your retirement portfolio and whatnot. So if you need any assistance, help, talk to Jerry and talk to David, and they both qualified advisor, and they will definitely give you an advice with what to do with your money. Hopefully you get a better return than a bank.
Thank you so much,
So
Henry, for being with us.
what will be the best time to contact you, Mr. Henry?
Anytime during the day, like not midnight.
Because
We got a mystery panelist, Chuck. I promoted Chuck. He put his hand up, and I thought, you know,
no,
Chuck's
sorry,
a very loyal viewer.
yes, yes. And you know what? Best part of it is I like your singing too. And therefore I thought the last event for this year, maybe, you know, we can have a song on a guitar with David. Why not? Yes.
All right. Well, I'll see if I can. Let everyone say goodbye, and then I'll try and bring up one of my recent videos, because my guitar may not be in tune. But I'll bring up a video at the end. Laurie, can you give us your final thoughts, Laurie? We are on mute. Hang on. We got to unmute you. Laurie, we need to unmute you.
Sorry, I
apologize. There you are.
I muted myself, but thank you for having me. I would like to invite you, if you want to do a real estate cafe out of my brokerage, or maybe on my sunset patio in the summer, we can do that. In the meantime, thank you, everyone. And I encourage everyone to invest in yourself by getting yourself a beach property. And not only can you get a great one in Wasaga Beach, but I also have associates on the Adriatic coast in Italy. And I have other associates in Jamaica as well, Montego Bay and Negril. Everywhere there's a sunset, I'm looking to sell.
Awesome.
Beautiful.
That's
and
great.
Happy holidays.
Thank you. And we will take you up on that, by the way, because that's our plan, is to start doing these out and about. And I think that would be great fun. So we look forward to doing that. Thanks for the invitation. Marino, how about you, buddy? Final thoughts?
Oh, well, thank you very much for having me on, David and Jerry. I really appreciate it. Laurie, I will be calling you about Wasaga, as well as I do have property 80 kilometers from the Adriatic coast. It's family property. So I have something to share there.
Okay.
If anybody wants to learn more about the immediate financing arrangement, I know our time was short, but I'd be more than happy to take the time and explain it to you in greater detail, and go from there. Just give me a shout or send me an email, and I'll be more than happy to run that by you guys again.
Thanks so much, Marino.
Thank you.
Jerry,
Yes.
final thoughts.
Well, I just want to thank you, David, for once again hosting a good session. Very informative tonight. Henry, thank you for your insight. Laurie, look forward to meeting you at the beach. Marino, great session. And closing, Merry Christmas. This is our last one before Christmas. Happy holidays. I invite you to visit my website, Canadian Investment Services. Wait till after the weekend. You can download our free financial planner. Get involved in our financial planning club. It's all free. So yeah, fingers crossed for this vaccine. It's coming. So let's hope it gets us back to a normal life. So thanks again, David. All the best to everybody. And I look forward to spending more time in Wasaga now that you're up there. So you've inspired me to spend more time in Wasaga.
All right, awesome. Jerry, thank you for co-hosting. Thanks to all our guests for being part of the show. It's been a very interesting year. We made it through the year, and we appreciate all of you, the attendees, for sticking with us and for joining us and supporting our businesses and being part of our monthly webcast, all of our very good friends. And it's not over yet, folks. There's still a couple more weeks. We can maybe close a few more deals. And let's see if this works on Chuck's suggestion. I'm going to try and bring up, try. Can you see the screen? Yeah.
There you go. Yeah. There you go.
Can you hear it? Maybe
Can't
not.
hear you.
Okay.
David, I think you need to share the video.
Oh, wait, can you see it?
Yeah.
You can see it, can't hear it.
Yeah.
No?
Yeah, you have to go to the option and share the volume.
Yeah. Okay. Not sure about that. We're going to have to try that. Another time we'll work on that, but thanks for the suggestion and for your support, Chuck. And everybody, we'll definitely have some music events like we used to in the near future. That's part of the plan, and hope to have you all up to Wasaga for some good times, God willing, in the not too distant future. Happy holidays, everybody. Good health to you all.
Take care.
Take care.
Take care. Bye-bye.
Yeah, thank you. Bye-bye. Thank you.